I've watched a lot of videos revolving around investing in the stocks of a particular product instead of buying the product. And that made me think if it's actually true. Could skipping that cup of coffee make someone a millionaire over time? I decided to test it through an Excel file. So let us consider this example. Let's say I'm spending 250 rupees daily and I spend it for 300 days on the coffee. So in total, in 1 year, I'm spending 75,000 rupees. The coffee company has 10,000 customers like me, each customer contributing 75,000. So in total, in a year, company earns a revenue of 75 crores. 30% is the cost of raw material, which is a variable cost. 24 crores is for depreciation, salary, rent. And before tax, the company's profit is 28.5 crores. Considering a tax rate of 25%, company's profit after tax will come at 21.37 crores. Now, what is the shareholding structure of the company? Let's say the company has currently 30 lakh shares and the earning per share as per the profit after tax of 21.37 crores will come to rupees 71. The next step is to compute the price-earnings ratio for the company, which in this case comes at 14. Now let us presume that this is somewhere near the industry average and hence the shares of the company are trading at a fair price. Also, one thing to note is that price-earnings ratio tells us that in how many years will the investor recover the investment. So for example, in this particular company, price-earnings ratio stands at 14. The investment of rupees 1,000 at the current rate of earnings will be recovered in 14 years. Since we have saved 75,000 in the first year, at a share price of rupees 1,000, we'll be able to purchase 75 shares of the company. So at the end of year 1, we have purchased 75 shares and the investment value is 75,000. Now, let's say we keep this amount invested for the next 9 years. So at the end of year 10, the company and the market can go in two directions. Let's say the company has a good growth and the consumer base increases at 10% every year. And the second case is that the coffee saving investing philosophy catches up and is adopted by more people and customers. So in the general parlance, the customers only increase to 15,000 and the spending at rupees 1 lakh each. Let's make the P&L in both the cases. So we have two cases here. In the first case, the customers are increasing at the rate of 10% every year. So by the end of year 10, we have around 24,000 customers. Each customer would be, rounding off the number, would be contributing at rupees 1,50,000. Now at this stage, the revenue of the company stands at 360 CR, cost of material stays the same, and let's say the fixed cost also increases at the rate of 10% every year. So the fixed cost comes at a level of 56 CR. So our profit before tax is at 1.95, less tax, profit after tax is at 150 CR, and the earning per share has jumped up from 71 to 489. Now this earnings per share will consequently impact the share price as well. So considering that the older PE ratio is the fair market PE ratio at this time itself, the share price of the company will jump up to rupees 6,856. The initial investment amount was 75,000, the value of which will be now 5,14,235. This is the good case, and certainly the amount of 75,000 becoming 5,14,000 is a significant growth. Now let us consider the second case, where the coffee saving investing philosophy has caught up. The customers have only increased from 10,000 to 15,000 and each customer's contribution to rupees 1 lakh. Now in this case, the profit after tax will remain at 42.75 crores and the earning per share from 71 doubles to 143. The stock price, since the P ratio is the same, will double to 2000 from 1000. The value of 75 shares will be 1,50,000, which, if we see from a purview of 9-year investment, may not be that great. How do we see if it's great or not? The best way to do that is to compute the compounded annual growth rate, which is 24% in the first case and 8% in the second case. Also, let's say the other fixed cost, if it increases at the similar rate, the CAGR will only be 6%.